A question I get every now and then from my clients is what is the difference between a balance sheet and an income statement? A balance sheet and an income statement. These two are probably the two most important uh, reports your business has. Balance sheet, first of all, is where a company, where a business stands in a point in time. A balance sheet is always about a specific point in time. So if you're looking at the balance sheet for a business for last year ending 2017, then you're looking at probably I'm assuming it's a calendar year. It's December 31st, 2017 balance sheet. Or maybe you're looking at the balance sheet where it stands last month. Last month was June, so it's probably looking at June 30th, 2018 balance sheet. Balance sheet is always a point in time. It looks at what a business owns and owes. Oh, isn't that cool? What it owns and what it owes. So what it owns is meaning the assets. Usually in assets, there's bank accounts, there's like all the money, all the cash in the bank accounts, all the accounts receivables, meaning that what its clients and customers are legally obligated to pay them for goods and services, for all of its fixed assets such as equipment, machinery, property it owns. Maybe there are some intangible assets such as intellectual property or technology they're building upon, so on and so forth. In terms of what it owes, its liabilities and equities. Usually there it's accounts payable, so any monies owed to vendors, distributors, suppliers, manufacturers. Other liabilities include payroll liabilities, notes payables, line of credit, things of that nature. So a balance sheet is always a point in time, but an income statement is always a period of time. So whether it's a year or a month or a quarter, income statement, also known as a P&L statement, profit and loss, is always about a period of time. And it's looking at the performance of it, just looking at the money in, the money out, in terms of how much money is made and how much money is spent. So in terms of money made, obviously it's revenue or income, and how much money is spent is costs and expenses. The reason why these two things are important, these two make up financial statements, and where these two are the very basis of financial reporting for any business. So for instance, if you, not if, when you file your tax returns for your business, and your tax return, in every business's tax return to the IRS, there's going to be your financials, there's going to be a balance sheet and an income statement. When you're getting audited, whether you're getting audited by the IRS or maybe it's an industry audit, there's some no, nonprofits, when they reach a certain size in terms of gross donations, they get audited. That's just an annual thing because that's what industry they're in. When you are looking to get financing, when you're looking to get a lender, or when you're looking to sell some of your equity, your ownership in return for an investment, they're going to probably want to look at your financials. When you're looking to sell the business as a whole, it'll be very curious for a business buyer who's looking to buy the business outright without looking at its financials. It needs to look at for the balance sheet and the income statement is where it stands. So there you have it. These are the reasons why these financials, balance sheet, income statement are important. Also the difference.